Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and today we are going to be covering the HECV product, which is the high early cash value product from MassMutual. The reason we're doing this is because, honestly, I think we get more comments and questions about this product than any other product. There's a lot of people that talk about it on the internet, on social media, and I think there's, while it's a good product, there's not going to be anything really negative about this, but I think there are also some caveats and things that you need to be aware of. There are some risks involved with it if you don't really fully understand what you're getting involved with. I always kind of tell people there's no free lunch. And so, a lot of times I feel like people get into this thinking it's going to kind of like solve all their problems. And there's some elements of this that we need to get into. And so what we did is I've got my business partner and kind of what I call the wizard behind the curtain, Tyler, on the call. And, so I'm awesome, man. So I'm excited because Tyler has never been on the channel before. He's a little bit nervous, so bear with him. And, but he's my business partner. He handles a lot of the policy design stuff. He's kind of engineer mindset, really analytical, loves this stuff. And so he and I just spent fair amount of time going through and really analyzing the illustration. Now, so what we're going to do is really unveil the curtain. There's a lot of people that will go through and share just kind of like random information and Excel sheets and all this different stuff. And I think it's really important to understand when you're talking to an agent, if you're looking to get one of these policies, for your full understanding and transparency. I'm really against Tyler, and we'll talk about this, I guess now, because you and I talk about this all the time. I get really, really frustrated at the fact that agents, when they're selling any product, not just this product, but any product, a very common practice is to just like take illustrations and put them on an Excel sheet, take the illustrations and maybe take like a snapshot of the tabulation, maybe the tabular section of the illustration, and just share that. None of that. First of all, that's totally against compliance to be able to do that. If you ever get anything with an Excel sheet or just a portion of the tabular section, if you were to read those, it says none of this is good without the full illustration, and no agent is supposed to be able to share those without providing the full illustration. So listen, there's a time and a place where the Excel comparisons and breakdowns are good and they're convenient. And it's nice to have that snapshot side by side if you've got different policies going on. But if any agent is ever sending you those without the illustrations accompanying them, you need to be really, really cautious, in my opinion. And so why don't we do this, Tyler? Like, cause you built an example illustration, and let's just get into it and talk about, first and foremost, how is the policy actually designed? What are we talking about when we're doing this high early cash value policy with Mass? Actually, zoom back in again if you can. There you go. That's better.
Yeah. So this is that tabular page that Chris was referring to, and you have to be careful. This one, a lot of times I see them. They come over as the supplemental value, which is all of the adjustments that the advisor or agent is adjusting behind the scenes. And so it does give you the annual net outlay, but a lot of the times it'll exclude some of the breakdowns that can be important. So if they're not sending you the whole, entire thing that gives you this information as well, just be wary.
Yep.
So
yeah. Cool.
So this was a design, Chris, that I see a decent amount of. So the HECV product with MassMutual is designed to be a fairly, even if you did 100% base, it's designed to be a pretty high early cash value product, right? And so if you had to kind of put that in comparison in general, I see that it's really good in the early years, and then it will lag behind compared to other products long term. So I know you preached quite a bit on make sure you're purchasing things that align with your long-term goals, not just your short-term goals, but let's dive into it. So this one I designed is what I call is trying to get the max amount of cash early on with the policy using PUAs. So you can see here that in order to do that, it's the whole life early cash value with LISR. So the first question that I always get is, well, what is LISR? Because no one ever understands what that is. So it stands for Life Insurance Supplement Rider. And think about it as and help me out here, you have better linguistics to everybody than I do, but it's basically like a 1-year term that decreases over time as more whole life is converted into the base policy. So
basically, guys, what they do is they take the MEC calculation formulation and they figure out, all right, based on what you're putting in, they do a term blend into the policy, utilizing this life insurance supplement rider, the LISR, and that term blend will slowly decrease as the permanent insurance increases over time. So the more mature the policy becomes, the more the more efficient it is. And so what happens is, so you can see here, they actually show this on the full illustration. They kind of explain it. It's a 1-year annual renewable term that gets smaller and smaller and smaller over time. Different companies call it different things. Like Mass Mutual calls it the LISR. One America has it. They call it the EBIR. It's all the same concept. And it's just a way to kind of beat the MEC limits and allow you to kind of have a blended term rider that shrinks over time. And the more mature the policy gets, the more efficient the cash value gets, and the more you can start dumping into permanent insurance. And that just is what it is. So that's how it works.
I keep them around, everybody. So that is the LISR. So it actually breaks it down. You can see the base premium is $4,000. The LISR premium is $3,000 a year. So that's $7,000. And then everything else, the additional $33,000 is into this additional life insurance rider, ALIR for short. And all this is PUA. So it's their version of the paid up additions.
What I want to point out real quick is that you got the base premium is $4,000, the LISR at $3,000. Now, the LISR, that's a rider. So that's a term rider, term blend rider. Now, as your term insurance gets cheaper and cheaper and cheaper, that LISR doesn't change in price, right? They've basically taken the cost of that term insurance over how it's been illustrated, and they've kind of averaged in that premium to kind of cover all of it and that going down. Is that fair enough? Is that
fair enough?
You know what I'm saying? And so what happens is you are on the hook out of this. So your base premium in this is $4,000 for the whole life insurance, $3,000 for the term blend, right? So basically that $3,000 isn't really doing anything for you. That is a pure cost that I think is important to understand, that is going into the actual term insurance blend that enables you to that enables you to put that $33,000 in. Right? Like without that $3,000, you could not put in the 33. So it's like a fee to kind of do that.
Yeah.
And an additional cost. It's not a fee. It's an additional cost.
Correct.
From a feature perspective that you need to leverage to be able to get that $33,000 in. Fair enough?
That's fair enough. And you know, all the companies do it this way to some degree, right? So it's just understanding what it is. And so if you see the breakdown, you can see $4,000 here purchases $367,000 of base whole life coverage. The $3,000 is basing the target face amount of $832,000, and the ALIR, the $33,000, is immediately in year one, so at issue, is buying up $131,000. Okay, so
that's full paid up additions. That's paid up additional insurance completely in place.
Correct. Right. So obviously that's just the at issue number. I ran this to be kind of annual premium. So they're basically assuming that they receive 40,000 all up front, all at once. Right.
Yep.
So the other thing, just a quick note about the LISR, is you can change that crossover period. So if you remember when we were looking at at this little chart, which we'll get into it for sure more as we get towards the bottom of the illustration. But obviously, the less money you put into PUAs, you can speed up this crossover point or extend that crossover point out. And then on top of that, Chris, which I'm sure we'll talk about more, is PUA charges, dividends changing, all of those various, if you don't stick to that contribution amount, this crossover point will change. And so it's just kind of being careful with that.
Yeah, we'll cover all that as we get into the illustration. We start talking about some of the variables and start reading some of the fine print of the contract as well.
So one good thing I will say about MAS is there, and a lot of the companies will do it, but they put the MEC limit at the bottom of every page, right? And so obviously that's just that initial 7-year test. You should always check annually every year to make sure that that's still the case. But they make it very easy for you to find what the MEC limit is.
Yeah, and for anybody that has one of these, it's easy. Just run a current in-force illustration on your policy. Any agent should be able to help you do that, and you can get that number. It'll be there on the in-force illustrations as well.
So you can see here for those, MassMutual did just increase their loan rate. And I believe it was 5% before, and you can see right now it's 5.73. So just something to keep that in mind. And you can see here they actually do kind of give you their adjusted cost index there, which I'm not going to talk too much about that because they all do that. So let's get into the actual breakdown. Okay, so the big difference between the tabular and the non-guaranteed and the supplemental value, which we talked about differently, is the tabular gives you the guaranteed as well as the non-guaranteed, right? And so as you make force changes, right, whether it's maybe I'm not going to make this $33,000 deposit, or maybe I can't make any deposit, it's going to change this, and this will tell you exactly what MassMutual is expecting, right, from a contract perspective. And then the supplemental is assuming all of these changes that you want to take place, right? So pause there for a second. I want to just elaborate on what he just said, because I think it's really important. So I always kind of tell people that these policies, having one of these policies is like a privilege, I guess is the best way to put it, right? Like as soon as you get it in, get one of these policies in force, this is saying this portion of the illustration is saying, all right, if we approve you for this, then this is, if you meet your obligation of meeting this premium payment, this is what we're obligated to. Now, as soon as you don't meet that obligation, their obligations change as well, right? Like I think that's really important to understand. And so, if out of this premium, 7,000, because a lot of agents, and I've sadly heard this, a lot of agents will say, well, you're only required to pay 7,000, 33,000 is completely flexible. So you can pay between 7,000 and 40,000 any single year. And if you miss the 33,000, you can make up for it. And, we'll get into like some of the nuances behind that, but it's really important that if you don't pay that 33,000 in a given year, or you pay a portion of that 33,000, maybe you pay 10,000 out of the 33,000 one year, that's going to have an impact on how the whole policy works. It's going to impact every element of the policy. And so I just think it's important that people understand that. We're going to go deeper into that in a couple minutes, how that works and like where the risks are on the PUA rider, and how the makeup for making up the missed PUA payments is potential, and how that works, and kind of where the risks are for that. So, and before you go any further, go back up real quick. Sorry. I just want to make a point to what I first started saying. Where are you? There you go. So the amount of the column, the second column from the right there, the amount of 1-year term
right there, right there.
Yep.
Exactly. So it starts off, he showed you it's $3,000 is what you're paying for that. That's the LISR, right?
Correct.
So that LISR is costing us $3,000 a year, right?
Yep.
That's 821,000 year one. It's 810 year two. By the time you get to year 10, it's 710. By the time you get to year 20, it's 556. You are paying $3,000 a year for that term, for that LISR rider every single year. Even as the insurance drops, the cost of that insurance maintains. So they basically like leveled out the premium, but it's a reducing term rider that you're paying a flat term premium for.
Correct. And you can see, you know, this is the net death benefit based on obviously non-guarantees.
Yep.
And so I think it's very important. And we have an illustration that shows fluctuating payments that we'll get into as well. So,
okay.
For this, you can see here the tabular. The biggest difference is I always see a lot of people, they illustrate a reduced paid up policy when an insured gets to age. In this one, I show 30 years, right? So, but in the tabular column, it'll actually show you continue to say, hey, look, Mass Mutual, like Chris was talking about, they're assuming that you're going to keep making that $7,000 payment in order till this LISR completely crosses over. Now, in this design, I had the LISR crossover, or the target crossover was at age 68. And so obviously you can extend that out. You can try to shorten it up. You can do a lot of interesting things there. And then here you can see that base premium being paid up until the HECV product is paid till age 85.
And a lot of those tabular or supplemental illustrations that we see, they say reduce paid up on them. And I think one of the key components to this is we talk about like not necessarily, I know a lot of people that are researching this online, they're not looking for the life insurance component of it, you know, the death benefit component of it. But let's face it, this is, we always kind of talk about like doing this is the most efficient kind of financial foundation you can have with your money, right? Like it's getting your dollars to perform more than one function in your life. And when you do an RPU, a reduced paid up to a policy, you lose the living benefits of that policy. Like if you lose the accelerated benefits of if you become terminally or chronically ill, right? Like you lose those benefits. So I know a lot of people would really stand to benefit a lot by having those benefits. And I think most people will want them there. And so it kind of bugs me when I see people selling based on an RPU and they're not sharing the rest of the illustration. And I literally see this at least once a day. Like I feel like illustrations come in with an RPU and people are like, oh, what is this? And I'm like, it's probably, honestly, like there are certain outlier situations where, yeah, that's what people want. But most of the time, I feel like an educated person will say, whoa, that's like, is there another way to pull this off and keep my living benefits? And the answer is yes, but the RPU thing just, it illustrates cleaner in a way, and it makes it look better from certain perspectives for the policyholder. It's less confusing for sure, but you lose a lot of the benefits.
So absolutely. So this is the supplemental. You know, it does give the breakdown. A lot of times, this is what I see advisors, they'll just send this tabular page. So they won't send anything else. They won't send any of the other things. They'll just send this.
Yep.
And a lot of times that can skew certain things. So you can see that everything will be identical. It doesn't give you the guaranteed columns. It only gives you non-guaranteed. But in this example, I did show a reduced paid up in year 30. I was actually doing this case for somebody that asked for me to audit it. So I was kind of mirroring what somebody else already did. And so here you can actually see they'll say reduced paid up in year 30. And so you can actually see the death benefit will go from 5.3 to 5 million. And then obviously you lose the ability to make any premium payments into this in the future, even if you want to. So I think really
does Mass Mutual handle that the way that I said? I want to make sure I'm not speaking. You lose the living benefits, the terminal and chronic.
Well, they don't have a chronic.
They don't have a chronic. Okay.
So they just have a terminal rider.
Oh, okay.
Yeah, which is I believe it's listed on page 2 here. Yeah, so they have an accelerated. So for terminal illness.
For terminal.
Right there.
Yep.
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 Okay. So
And yeah, okay. So that's so their living benefit from that perspective isn't as competitive if that's important to you as a couple of the other companies.
One thing that I would like to point out is, so let's get into a little bit about how the ALIR works and the flexibility, and then we'll show the illustration that reflects this. Okay.
Yep.
So if you keep going, which is why the full illustration is so important, they actually give you the entire rules, regulations, features, all the details that you would want to know in the illustration, right? And so the first thing I always like to point out, there's two different types, scheduled and unscheduled, right? So scheduled is something that is you're scheduled to do, right? Which is what we kind of saw. And then the other ones are kind of more used for maybe an initial deposit or a one-time deposit or a catch-up feature, which we'll talk about in a second. So the first thing is I like to go down here is they have a 10% charge for the ALIR, right? So that means that any deposit, you put in $100, 10% of that's coming off the top. So $90 is getting.
In this situation, we put in $33,000. So $3,300 of that is coming off the top.
Correct. So, and they less an expense charge right here. So it's literally, and on top of that, there's modal charges as well. So if you can pay your insurance, and then actually, I think we kind of skipped over that. If you can pay your insurance policy annually, and this is across every company, they all build in a modal card. I relate it a lot to like your auto insurance, right? You pay your full 6-month premium, you get a little discount than paying monthly.
Yep.
And so that is on page 5. So you can actually see, and they all are pretty much the same, around this 7 to 9.5% APR. So if you paid this monthly, you're not paying $40,000, you're paying $41,760, right?
Yep.
So make sure that when you're illustrating or when you're moving forward with a policy, a lot of times I will make sure that the monthly amount is equal to the $40,000. And so if a client decides they want to pay annually, right, then they're getting a slight discount. So maybe it'll be $38,500, right? Something like that.
Yep.
So just kind of keep that in mind when you're looking at illustrations. So the LISR page, sorry. So the next thing is the rider payment flexibility. They actually put a whole column in here for people. So the first one that I like to talk about is really the flexibility, and it's not exactly clear lingo, so that's why I ran a comparison. So the policy owner can pay less than the billed scheduled premium and then make catch-up unscheduled payments at a later date, okay? This feature is subject to certain conditions, summarized, keyword, summarized as follows, okay? The insured must be less than 65 years old, right? Okay, that's pretty self-explanatory. The catch-up.
That's also important because I feel like a lot of times people start late with this, and that definitely applies to a fair amount of people that reach out.
The catch-up payment must be made after the completion of 3 policy years. Okay, and so what does that mean? That means that we're at this $33,000 PUA number, right? And if you drop that PUA from 33 to 10, and you do that for 3 years in a row, and you don't go back to the 33,000 within that 3 years, you can't catch up anymore, right? And so on top of that, the unscheduled payments must be made on the policy anniversary date within 2 years, right? So within 2 years following the reduced rider payment. So on top of that, if you don't make that catch-up period, right, 10,000, right, if you drop from 33 to 10,000 becomes your new maximum PUA, or ALIR, I'm sorry, for ALIR for Mass Mutual.
ALIR, yep.
But so, yeah, go ahead.
But what I want to have you explain, how does it work with using your numbers? If 33,000 is the example, you reduce that to 10,000 for 3 years. And so that's basically 23,000 less, right?
Mm-hmm.
And so that 23,000, if you look at that over 3 years, that's $69,000 in ALIR that you didn't contribute to the policy. Can you take that 69,000 and put it in the policy year 3?
So the answer is no, but with LISR, you do get a little bit more flexibility, but then it changes that crossover and can change some of the MEC rules. So we'll talk a little bit about that. But if you're talking about just the PUA catch-up or the ALIR catch-up, the answer is no.
So I want to make that really, really clear, because I think a lot of times people sell this like, hey, you can catch up, meaning like if you reduce it, you can always re-increase your premium back to the original in that 3-year period. And you can kind of catch up and put extra money back in the policy that you haven't, but it's not going to be necessarily the full 33,000 total per year. And I think that's an area that's misrepresented very, very often.
Yeah. I mean, people that describe any of these things as unlimited flexibility, not exactly the case, right? They're certainly flexible. You know, they definitely have some flexibility to them, but don't make it think like, oh, I can pay this for 10 years and then come back and do it again. It's not going to work like that, right?
Even in the 3 years that
it says, in the 3 years,
you know,
it says it right here. So where the MassMutual does add an extra layer, right, and it can be used to someone's benefit, and it can also be used to their detriment, is the LISR, right? So that's kind of how the ALIR works. The LISR, right, which this is kind of where they talk about that 1-year term, right? They give you a graph so you can kind of understand it. So here, which is where MassMutual does hold a little bit more control, is so the LISR rider premiums less a premium expense charge, right, which is guaranteed not to exceed 12% in the future years and is currently equal to 10%, right, of any rider premium. So currently they could increase it to 12, and any applicable mobile charges and policy dividends are used to purchase 1-year term insurance, blah, 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 combined to equal the target face amount, right? So you have your base face amount, the LISR target face amount, which brings you to your total. So where it gets confusing, the amount of the term insurance provided by is determined annually, and the cost of term coverage is paid at the beginning of each policy year through the LISR rider's policy dividends, and if necessary, they will surrender paid-up additions in order to pay that LISR premium, right? As the amount of paid-up additions increases, as dividends are credited and LISR premiums are made, the term portion of the decreases, just like we talked about. And then at some point, the term portion will completely replace at the crossover point, right? So the big thing that I read in this is it's just something to be aware of is LISR premiums are calculated using current dividend schedules and current term charges, neither of which is guaranteed. Now, we all know that dividend schedules are not guaranteed, but the fact that their current annual renewable term charges are also not guaranteed is something just to kind of keep in the back of your mind, right?
Yep.
And so they're relying a lot on the non-guaranteed dividends to basically make sure that gets completed at that crossover date. And if not, okay, so failure to make sufficient premium payments will cause a permanent reduction in the target face amount, okay? And so my biggest fear or educating individuals that are buying this policy is if you're really getting this policy as close to the MEC limit as possible, right? We all know that MEC limits are tied to total death benefit amount, and you have a reduction in this death benefit amount, you're potentially exposing yourself to some risks, right?
Yep.
So it's just something to be very careful of when, illustrating that, right? And so one thing that it even says in bold, we strongly recommend that you look at an illustration showing a lower dividend schedule to see an impact of LISR premiums and other policy values, right? So to see if, hey, am I going to have an issue if dividends increase, which you can't illustrate, but at least on the decreasing side, right?
Well,
so
I mean, if dividends increase, then you're not going to have an issue with paying the premium. But like this is, I think, applicable for people that have bought this over the past decade when dividends were going down, right? Like when that was happening, as dividends go down, and if you don't fund the policy properly, you could run into issues.
Correct.
Yep.
Right. And so one thing, right? So the rider premium continuation, right? After this rider has achieved a crossover and it is paid in full, you may elect to continue to pay rider premiums subject to the limits described in the contract to purchase additional PUAs without evidence of insurability. So that's kind of that. So let's talk about what it looks like when you start to reduce those premiums, right?
Love it. Yeah, okay. This is key, guys. Here's the deal. Let me try to explain this in the cleanest way possible. So when you run these illustrations, obviously the illustration softwares are basically like supercomputers running all these tabulations and calculations and variables for death benefit, funding mechanisms, and all these different things that kind of come into play. And so when you look at this, what Tyler did is basically ran all the same variables with the 33,000 in the ALIR, the 4,000 base, the 3,000 LISR. Everything there is the same, right? And so then what he did is he said, all right, what happens if we fund this at a different level, at a lower level? What happens if I say I don't want to pay the full 33,000 ALIR, I want to then drop that number to 10,000. So you can see year 3, that's 17,000. That's 10,000 for the ALIR plus 7,000 total for the base and the LISR. Now, then he's saying, all right, how do I make up for that, right? And so if you do that, you could see the next year he was able to put the 40,000 back in. But I think a lot of times people think like, hey, if I do that, I can just go back and maybe on top of the 40, go back and put even more, which, what I'd like to do, Tyler, is have you go through and show what you did as far as reducing that ALIR every single year for a short period of time. And then as you try to go back and add it in, if you don't do it, if you don't contribute the scheduled amount for a long enough period, for that 3-year period, it can cause challenges in you being able to go back and put as much money into this as you want to.
Correct. So in the first 2 years, you can see, I kept it the exact same, right? And I'll actually show, I know we talked about being careful with showing side-by-side Excels, but I'm showing the illustration, so I'll show the side-by-side Excel at the end. But then I go to reducing it to, like Chris said, from 33 to 10,000, right? 10,000 plus 7 equals 17. And you can see that I said, okay, I want to make sure that I still keep it within that rule of the 3rd year to go back to the 40. Okay. And so I go back up to the 40,000. Now, one note I want to make a difference of is you go from 810 to 799, right? So that amount of 1-year term. And then I'm going to go back to this one really quick. I didn't really look at it. 799. It's the same, right?
Yeah.
And so that just goes to show you that 3,000, that crossover, you're still paying for, right? And so now you have less cash going to PUAs altogether because you're not funding it as high, right?
And that fee that you're paying for the LISR just makes the policy much more inefficient if you are not funding it the way that you're supposed to.
It puts a drag, yeah.
It puts a big drag on it.
And so and so if you keep doing that for a long period of time, this 1-year term it'll extend that crossover period out further. Okay. So then I said, okay, well, let me bump that up to 1,000 a month. So 12,000 plus the 7 equals 19, right? So instead of 33, I dropped it down to 12, and I did that for 4 years. So I wanted to make sure, okay, what if I do it past that 3-year that ALIR said I was able to, right? And then what I did was I told the system to say, okay, I want to go back and pay the rest of my premiums at the 40,000 level, right? At that the 33,000 level.
Yep.
And you can see that it struggles to allow me to do that, right? And it does eventually let me get there, but it's not doing it so much in the ALIR side. It's doing it as, okay, he wants to cross over the LISR. So I'm trying to keep that scheduled LISR payment down, right?
Yep.
And so that's where it's allowing you to make up those premium payments.
Mm-hmm.
But at the same time, we already talked about how, if you don't plan on keeping to make this $40,000 scheduled ALIR long term, and you keep it at a 19,000, it's going to have a drastic impact, because now you're paying for a term rider charge that you never really are using.
Right. Yeah. And it's one of those, and that term rider charge is there. That's just like, it's part of it. Right.
Mm-hmm.
I mean, if you remove that, then you're going to even reduce your ability to fund it to the level that we're talking about. And what this looks like here is they'll allow you to catch up, right? But what you're doing is you're catching up over a long period of time, right? Like that, you'll get back to the 40 eventually, but you're looking at a decade basically of not being able to put money into the policy the way that you wanted to, which is crazy.
Absolutely. And so it's just, like we talked about, is it's just, sorry, I was going to try to run one here. It's just a matter of being educated, right, Chris?
Yeah, for sure.
You just want to make sure that you understand that there's not unlimited flexibility,
correct.
With really any company's policy, right? They all have different nuances. They all have different, pros and cons. So you just want to make sure that you're aware of what all of those, what all those features are.
Got it. Yeah, no, that's good. Now, do you have the side-by-side Excel sheet, right?
Yeah.
So pull that up if you could. Yeah, there you go. And let's go through and just kind of explain this. And this is what I was saying, guys. A lot of times agents will send these to you, and I have no problem with the use of these in the way that we're kind of showing you, because it makes life easier to look at a side-by-side comparison. However, you better make sure you have the accompanying illustrations, the full illustrations, and not just the supplemental that accompany this.
Absolutely. So, and keep in mind that, so just so everyone understands quickly, you have your annual premium. I plug in the cumulative outlay, so the total money you've put in, as well as the cash value in that based on the illustration, the death benefit.
That's the non-guaranteed net cash value of the policy.
Correct. Yes, non-guaranteed. Yep. Thank you.
Yep.
The outlay to cash value percentage is basically the cumulative outlay, or the cash value divided by the cumulative outlay, just to get your percentage of cash, right, of what I've put in. And so you can see here, this is a regular HECV, the 40,000, no LISR, no everything, just 40,000. And you can see that the base MassMutual basically puts it at 80%. Obviously, you can see here, you don't lose too much efficiency in the early years, right? If you guys remember what I talked about in the beginning, the HECV is designed to be early on, but if you make those fluctuations, it will slowly start to lag. And so if you look down here, you can see after, and I'm just skipping kind of towards the bottom, you can see that from an efficiency standpoint, I mean, you're down 40%, right?
Yeah.
Chris?
Yeah, it's pretty substantial.
And so obviously if you need to lower your payments, you need to, and you should, but you just want to keep that in mind when purchasing these.
Yeah, you just need to know the cause and effect, right? You got to understand, like, all right, inputs and outputs. Like every time you change the input, it's going to affect the output on the back end. And the concept of compounding, works for us. We always talk about the power of compounding interest and growth, but when you don't fund it properly and there's drag on the policy, there's a compounding effect on the negative consequences, the negative side of everything as well. With these policies, and it doesn't make it bad, right? Like you just got to understand what you're dealing with, right? I mean, they're still decent, but if you need that kind of flexibility, sometimes a policy like this, you may think it's more flexible than it really is, or maybe the downsides of that flexibility are too costly for what you want. And this is where a lot of times I feel like these are maybe oversold as that vehicle, and there are other policies that are better fits for somebody that is really kind of naturally attracted to the HECV Mass Mutual kind of policy, right? This is where I think some of the other companies have different policies that can be customly designed to accomplish the same thing from a flexibility perspective without locking into that kind of this contract, right? Like this policy with them. And so that's because, I mean, at the end of the day, when it comes to PUA flexibility, Mass Mutual is not a leader as far as like having the most flexible PUA elements to it, right? And so those are just, once again, this is when we say you have to align the policy design with your goals and objectives. I know that seems like a very vague statement to a lot of people that don't understand this stuff to this level, but this is the kind of stuff we're talking about, right? Like, is making sure you don't make short-term decisions to solve long-term problems, right? Like or long-term goals. And that's just what it comes down to. So, you know, I don't think I've seen a video, maybe it's been done, maybe other people have done it, but I don't think I've seen a video that goes into this much detail. And so when Tyler and I were kind of talking about this, we were like, man, you know, this is just kind of something that everybody should see and have clarity and transparency into, because there are a lot of people looking at these policies. And so, you know, I mean, we have access to them. We you know, if this is something you want to like really dial in, you can reach out. But I'm going to tell you right now, there's other options that you probably want to look at anyway. And I'm a big believer that you shouldn't just like deal with one scenario. Like, look at things side by side, look at multiple options, multiple carriers, multiple potential solutions for you, and then make an educated decision from there.
And so, Chris, I know we were talking about before, you had asked like, okay, how much can you catch up? Yeah. The software with the LISR will allow me to catch up to 87,000 in this year. But again, if you miss that 3-year window, it does not let you do that, right?
Yep.
So it's still that 3-year that window. So I just kind of ran that on the side.
Okay, cool. That's good. So those are all the things, you know, at the end of the day, one of the things that I kind of, I don't know, that I pride ourselves on, you know, at Life 180 and with our team is just that full transparency, the full education, you know, for you to really, if you are looking at doing this for yourself, I mean, it's a big decision. We're not, you know, most people as they look at doing this, they're looking at putting a fair amount of money through these things. And it's a big decision for you, for your life, for what you're doing for your personal finances and reaching your goals and all that stuff. And so I just am really, really big on the idea that nobody should ever put money into something that they don't understand. And so, you know, our focus is not to sell anybody anything, is to hopefully identify your goals and objectives and provide solutions, and then educate you to make a decision that you are not just comfortable with, but extremely confident with, right? Like, and so one of the things I pride ourselves on is like most of our clients can understand this life insurance stuff better than 95% of the agents, if not more, out there, right? And like that's a big deal to me, and that's, you know, Tyler's amazing at that, and you know, that's one of the things that I pride with all the agents that we're teaching and coaching. Like that's the main focus.
Yeah, and again, Chris, if you get a lot of feedback on this deep dive on this specific product, you know, if you know, leave a comment if anybody wants to have us audit a, you know, Guardian, Pen, all these. There's so many products. You just want to make sure that you're getting that full picture.
Yeah, I mean, auditing policies, we do that a lot. You know, if people are looking at doing that, we do that a lot. But then, you know, I would say as well, if you have anything about this, like, listen, because they're just illustrations that, you know, what Tyler kind of showed, we would have to run 15 illustrations with all the different variables and moving parts of like things. So it's easy to pick and, you know, choose and dink and dunk us on like, oh, you didn't show this or you didn't show that. What I would say is, if you have a comment or question, transparency is the goal here, right? Go down below. We can continue this conversation on this test case scenario. and kind of walk through like, hey, if I did this, what would it look like? So just let us know if you have the questions about it. We're happy to kind of help continue the conversation and provide that transparency and go from there. Anything else from you, buddy?
That's it for me. That's enough for my first video.
45-minute for the first one, buddy. Good job. So, all right, guys. Well, that is it for today. If you have any questions, as always, leave them a comment in the comment section below. I will do my best to engage with every single one, and we will, like I said, happy to follow up with anything we can. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Until next time, have a blessed, inspirational day. We'll talk soon.